Welcome back, everybody, to another episode of Acquisitions Anonymous. We talk about a really interesting deal today. It's a metal service center company on the west side of Chicago, and it's kind of follows the arc of a traditional deal evaluation. You look at it and you're like, oh, this is awesome. This is amazing. This is just like right in the sweet spot. It's a good deal size, really healthy margin. And then you start pulling back the details. You get into the weeds. I don't know. It's not so much. Then you get a little bit further and you're like, I don't think this deal would work. Their price expectations are too high. There's too much nuance to the deal. They want to be paid for the inventory in addition to the purchase price. It's just got all the traditional elements that make it really difficult. We talk about the broker dynamics. We talk about kind of the specificity of what they do and whether or not it works for a searcher. For this size deal and this seller dynamic, sometimes these deals take so long to kind of get back down to market expectations that buyers have already moved on and found something else to close. But I think we talk about some things that are really helpful, both as a buyer from a buyer's mentality and the viability of doing a deal like this with the debt that would be required for it. So big thanks to our sponsor this week, and hope you enjoy the episode.
This episode of Acquisitions Anonymous is sponsored by Acquisition Lab. Acquisition Lab and their team, they've been longtime supporters of the pod, and they provide a really great service for people who are looking to acquire a business. So it's created by Walker Diebel, who's become a friend, the author of Buy Then Build, How to Outsmart the Startup Game. So Acquisition Lab's an accelerator with a highly vetted, cohort-based educational and support community for people who are serious about buying a business. So a lot of our listeners like you tune in every week to our deal reviews. You want to get in on buying a business. You're on this podcast because you're trying to learn how to buy a business. But if you're not quite sure where to start, Acquisition Lab is a great place to start. So they exist to help people buy a business and to navigate all those complexities of the process, everything you hear us talking about on the show. They provide a proven framework, tools, and resources that support you all the way from search to close. They do it. There's a whole bunch of educational material and support. So if you're serious about buying a business, check out acquisitionlab.com, or you can actually email the program director, Chelsea Wood, directly. Her email is chelsea@buythenbuild.com.
Welcome back, everybody. Another episode of Acquisitions Anonymous. Let's go. Michael's in the background. We're very amped. We're coming off of an episode where we decided that we are possibly going to buy a business. And so now with fresh eyes and fresh ears and wind in our sails, I don't want to let people down because we are still going to be very critical and we will probably like one deal out of 100. But Heather is going to lead us today as we look at a metal service center company for sale.
All right. So this is a metal service center company for sale in Kane County, Illinois. Asking price is $7,500,000. Gross revenue is $3,469,000. EBITDA is $1,181,000. Inventory $700,000. There's a rent shown of $5,440 a month. Description: highly profitable with diverse customer base. Opportunity summary: our client, the company, is a Midwestern-based metal service center focused on tool steel distribution. It offers value-added services which include production, saw cutting, surface grinding, and six-side squaring. The company purchases raw materials directly from steel mills and wholesalers and then processes the steel to customer specifications. The company's core competencies include high levels of service, product knowledge, availability, in addition to machining services. It differentiates itself from competitors by offering services that are not typically offered elsewhere in the marketplace, including next-day delivery, non-standard plate sizes, value-added machining services, and free delivery. The company has produced strong financial results over the past 5 years, with 2022 sales and adjusted EBITDA of $3.5 million and $1.2 million, respectively. Strong reputation in the market, diverse customer base with low levels of customer concentration, focuses on small to mid-sized jobs, and serves many customers each year. Investment considerations: growing and profitable, CAGR of 6.2% from 2018 to 22, adjusted EBITDA of 34% of sales for 2022. They're sort of repeating themselves. Top 10 customers accounted for 35.9%. Diverse customer mix, future growth prospects, CNC machining centers to offer machining per unit. Let's see what else is in here. And these are just growth prospects. This is a whole list of growth prospects. Add another location closer to the metro area. Actively pursue surface grinding jobs. Add a third shift. Scrolling down, they're in a leased building that's 17,000 square feet. So what do we think of this one, guys?
So there is a link here. They have a full teaser, Heather, that I just pulled it up
I
to
see it
share
now.
it. Yeah,
Yeah.
I think what's
Okay.
interesting here is they give us a bit of the trajectory of the sales, COGS, and net income, which is usually on something like this the first place I go. I think we've had a couple different guests come on who've talked to us about, not all manufacturing or not all kind of metal kind of stuff is different here, right? It's like you have some of it that is like these guys who appear to be using very complex machinery that has a lot of capex with it, and you have folks like Reg Zeller's business who's using stuff that's like 80 years old and doesn't break down all the time and have a bunch of capex. So anyway, that's why I immediately, when I see a small manufacturing or organization like this, I go straight to like NOI, and I want to understand, how much depreciation and amortization is in that adjusted EBITDA number that they're giving us.
Yeah, so there's a lot of detail actually on this page, and we're going from 2018 of 2.7 million in sales to 21 3.8. So they've grown quite a bit on top line, and margins have improved. Gross margin has gone from 42% to 51%, and adjusted EBITDA margin has gone from 22.7 over to 34%. Oh, yeah, I'm sorry, I missed the gross has actually gone to 53.8. So in 2022, they've got really strong margins. Shrunk a little bit on top line from 2021, but looks like a solid performer for the last 5 years. Let's see, number of jobs. They've gone from 3,800 a year to still just 3,800, 3,787 in 2022. So their job size has increased. Largest job size from 22,000 to 48,000. So they're doing larger jobs. Average job size $719 to $917. So that's pretty small jobs. Seems like the average job size.
These are like small batches, which is kind of an interesting niche because a lot of these tool and die or, kind of smaller metalworks providers, they're usually located next to some kind of larger manufacturing outfit like a Husqvarna plant or something, and they need just this little piece of metal that covers the trigger guard on the chainsaw. And it doesn't make sense for them to source, millions and millions of these at a time from a larger company, and they just need this kind of quirky one-off thing. Or it may not even be a part of the component. It may just be something that they use like when they put together the pallets to ship the thing. Like it's just weird kind of small lots. And there's a reason that these companies, like this particular company that's for sale, there's a reason that they don't get that large. And it's because they kind of have to play in this no man's land. And it's more than just a guy with a welder in a fab shop, making, just one-off things and doing trailer repair. But it's not quite so big that it's somebody who can run millions and millions of parts. Like these average orders, $917. I mean, you're talking about small kind of odd batches of things.
So I looked up where this is. It's West Chicago. It's in the next county over from Chicago. So heartland of kind of industrial America. There's lots of stuff being built there, all kinds of like heavy industry. And so, Mills, are you reading like what the niche these guys are actually in is said factory has a part break. They need another one the next day. They call these guys. If they fab them a new one and it's there, overnight and they're back up and running again. Is that kind of how to think about it?
It's a little bit hard to tell because they talk about tool steel. So one of the interesting things about tool and die shops and like stamping shops is that the replacement value of these things, kind of like Reg talks about and Josh talk about with forges, it almost doesn't make sense to go buy new equipment, and to start one of these from the ground up. It's very, very CapEx intensive, but you can kind of step into an existing operation and, the depreciated value of those assets, they're usually very old, but they still work and they still get the job done. It's hard to tell though with this because they talk about tool steel distribution and some value add services. It says include production saw cutting, surface grinding, and 6-side squaring. So it may be that like they're talking about they buy raw materials directly from steel mills and then process into something for somebody else. So a lot of these big manufacturing outfits may have like for example like a large planer, and those planers have these really really robust cutter heads that have multi-sided discs that they're running wood through and they cut. Those companies don't necessarily buy directly from the steel mill because they have to get these things kind of, specified in just a certain way or get them modified in a certain way. And that would make sense, right? Why the orders are this way. They're just kind of odd, and they're things that kind of last for a long time, but there is wear and tear, and they do have to buy them on a reoccurring basis. It's hard to tell exactly what they're doing though.
So why is this listed on Buy Biz Sell or Biz Buy Sell? Like,
it's so small.
There's nobody in private equity who's going to roll all these up already?
There's so many of these things, man. I mean, there's so many tool and die and like small kind of $1 million to $1.5 million, maybe $500,000 to $1.5 million, metal tool and die stamping, kind of metal post-production. Some of them are just taking things and processing metal after it's been produced.
Oh, so realistically, what you're dealing with here, so from a roll-up perspective, there's no economies of scale from aggregating these. Like you're only servicing the nearby market, all subscale.
Yeah, like freight is a component for sure. I saw one person several years back who had vertically integrated really, really well, and they had basically, said, okay, in large manufacturing operations, maybe they need like these huge like strainer baskets, right? That you put a bunch of components in and then it gets dipped in like a chemical bath. Well, we want to now source the raw ingredients for these metal baskets. We want to fabricate the metal baskets, and we want to coat them with a very specific thing that allows them to be dipped into a chemical bath. And they had vertically integrated that way. That kind of makes sense. I know another weapons manufacturer that they, have kind of vertically integrated to say, hey, not only are we going to make the kind of polymer, the plastic handles for guns, but we're going to buy a machine shop that can do the, rifling and the manufacturing of the barrels and the different components. And some of that is stamping, some of it is CNC milling, some of it is small batches, some of it is really large runs, but they've just vertically integrated. There's not a lot of people who say, hey, I want to take this one company that does this one thing and buy them all over the place like this, because they're so kind of disintermediated, right? There's not a lot of economies of scale because they deal with these quirky kind of odd customer sizes.
Yeah, I'm also looking at the multiples being pretty high given what we're sort of, guessing about this business. And they want, not only 7.5 million on 1.2-ish, a little sub 1.2 of EBITDA, but they're saying not included in the asking price is $700,000 of inventory, which is always something challenging when they don't include something in their ask price and want you to pay extra for something that is needed to run the business.
Yeah, I would say it's completely unrealistic.
Right.
So just from a market dynamic standpoint, I'm competing basically on geography, right? Of where I'm located nearby these folks. And I have a kind of a light moat that, there's a level of investment that it takes to go start up one of these things and buy all the equipment and stuff like that. But that's easily replicable. If I was to get to a certain size, somebody else could just come in and start to chip off parts of it by buying some of these machines secondhand even and starting in their garage and that sort of thing. So you're dealing with that, and you can never really get bigger because once you get to a certain scale, you have no margins because the stuff gets out offshore to China or wherever they're, Canada or wherever they can produce Mexico produce the stuff cheaper if you're doing bigger jobs than what they have. So really, I'm buying this and I'm kind of thinking this is as big as it's probably going to get. Like it's going to be challenging for me to make it larger because my geography is not going to grow.
Yeah, I think it's very capital intensive to grow. Like you'd have to go find something similar, an hour and a half to 2 hours away. And the organic growth, I think, is difficult. Now, there's always the case to say, like they talk about adding a third shift, they talk about adding a CNC router. Those are like the equivalent, right, of our e-commerce deals that say, just go sell on your own.com. That's very, very difficult. Adding a third shift, my guess is that the skilled labor and semi-skilled labor that's associated with doing this, they're already stretched thin, and there isn't a huge line of people who are like, "Hey, sign me up." There's no mention of union versus non-union, but I'd be willing to bet that's a huge dynamic here. And the reality of just add a third shift. I mean, that's like, hey, just grow a third arm. I mean, that's a very difficult thing to do. But my question is, how sustainable? These are significant margins. I mean, like pretty freaking significant margins. How sustainable is it? And how sustainable is it? Not just can you grow and keep this margin profile, but can a new owner step in and actually, substantiate these margins and maintain these margins? Somebody recently tweeted about it, and I think it's one of the hardest things to do, to step into a business this size where the founder most likely is incredibly good at extracting all of the yield out of the business that they can. They may not be the most tech literate. They may not be the most savvy when it comes to, right, building a robust sales pipeline or something like that. And they may not be the best, modern managers, but they are incredibly good at yield on labor and yield on their production lines. And so to come in and think, oh yeah, I'm going to be able to maintain these margins is usually not very realistic.
That makes a lot of sense. And any kind of manufacturing, any kind, as a lender, we say you've got to have a manufacturing background. You've got to have experience in the industry. But then this is so niche that, whatever experience you're bringing probably may not even be good enough to do what you're saying, Mills, to really, this is a lot of customized stuff. And you're right, this is somebody working really hard and really smart to get to where they are. So who can really buy this is a really tiny market. If we're saying it's not really good for roll-ups or someone who's looking to scale, and it's not good for most buyers because they just don't have the skills, the buying pool is extremely limited here.
All right, taking a quick pause here. I have something to tell you. This is Michael. I hate bookkeeping. I hate bookkeeping. I hate doing HR. I hate doing all that kind of stuff. But for bookkeeping, I have found a solution. It is my friend Charlie's business called cloudbookkeeping.com. So that's cloudbookkeeping.com. They are your perfect partner if you want to get bookkeeping out of your hair and focus on making your your customers happier and more successful. So please give them a call. Call Charlie, cloudbookkeeping.com. Tell them we sent you. They're a great way if you're a business buyer, if you're a business owner, you're tired of hassling with getting your bookkeeping done. He's got a whole fleet of people that are well-trained and work for him. He's located here in San Antonio, so I can tell you because of that, he's awesome. And they're a great partner for you to potentially call to help with all your bookkeeping needs so you can do the important stuff in your business rather than worry about getting your books right. So give Charlie a call, cloudbookkeeping.com. And now back to the episode. And then you have a seller that, my other guess as to why this is so publicly listed is because the seller here has decided they think it's worth big dollars. And, this kind of is one of those, the price really becomes a big problem, I think, for most potential buyers. Because you have to imagine there's somebody who is in this business nearby and would be happy to own this business, but there's just no way they're going to round up $7.5 million to go buy a business that they know very well is probably should trade for 2.5 to 3 times NOI based on what's going on here. So, this is what happens, I think, when you price your business at double what the market's paying for it.
I went and looked at a deal a few years ago, probably 3 or 4 years ago, that was almost identical to this, about an hour away from here. And I mean, very, very similar dynamic. The margins were not as high. It was probably, I think, closer to about 5 million in revenue, but similar amount of free cash flow. And it was one of those things that it ended up sitting on the market. I went and did a site visit, really great people, kind of a cool, semi-sustainable competitive advantage and like a nice little niche. But, they just had unrealistic expectations, and they just had to wait and wait and wait. And there was a weird partnership dynamic, and, that doesn't get better with time. Usually people get more and more resentful. It was quirky in that it was a C Corp, and they wanted to do a stock sale, and they wanted to carve the real estate out. The real estate was owned by the entity, but they wanted to carve it out, and it had not been paying rent, to itself. But then they wanted to charge rent and didn't really have a fair understanding of the way that impacted the, adjustments to free cash flow. And so it just was like death by a thousand cuts, and they had high price expectations. And so a searcher ended up buying it, and I don't really know how it's gone, but it was one of those things where it's like, if this many people have passed on it, and it's been on the market for 3 or 4 years, which this is a hint, right, that it's a little bit dated because we're in August of 2023 and we don't have any kind of year to date financials for 23. I'd be curious, right, how realistic this seller's expectations are. And they probably had a lot of people kind of kicking the tires, and this person probably is still underwhelmed by what the offers they're getting.
It's interesting. I looked at the broker, I Googled him, and this, what is it, Mart Partners. It's a one person show. And he says he's done 17 transactions or 30 transactions in 17 years. I think it was the numbers he had. I was like, wow, that smells like a broker who is totally comfortable with taking on clients with unreasonable expectations and then just stringing them along until they come to their senses. So anyway, that kind of backs up our thesis that that's what's going on here, and why nobody already in the industry has taken a look at this, why no search funder. And Heather, I mean, is there any way like anybody could get like an SBA loan or debt on these type of multiples in this market?
Not at this multiple, you can't. I mean, unless you're paying. I always describe it this way: you can put debt on. You can overpay if you want to. The lender's not going to stop you. They might look a little side eye at you because why are you doing that? But but we're not gonna tell you not to. You just only can afford so much debt. So if you look at EBITDA, you can always just sort of rule of thumb it and say, how many turns of debt could I put on this? And if you're going SBA, it's a little under 4 turns in this interest rate environment. So sure, you can pay this price, but you're going to be putting a lot of equity in if you do that. And again, your lender is going to look a little sideways at you as to why you would want to pay that once they look at the deal. And back to Mills, your point about rent, and folks that own the building and aren't paying rent through the business, that is a really common problem. That it kills a lot of deals. People invest time, so it's one of those questions you should always ask in the beginning. Do you own the real estate? Okay, what kind of lease payments are going through this business, and how does that compare to market? It takes 3 questions. And you can not waste your time or show them, look, then your earnings are really this much less to any new buyer. It's simple math, but it's missed a lot, like you said, by the sellers and then their brokers who should not be missing that, but are often.
So what price would you want to pay for this? And is it about 2.5 times, or is 50% of where it is priced right now?
Yeah, but this is a tough one because I feel like you also probably have a replacement salary in here that's going to reduce earnings a little bit more. So I'm saying it's maybe like 900,000 of EBITDA that you're hopefully buying.
Yeah, cash flow that's available for debt service.
Mm-hmm. Yeah, maybe, and then maybe no more than a 4, but probably I would want to pay a little bit less just because this is so CapEx intensive and labor intensive.
Yeah,
we don't have the info here because I don't think it's really represented, but the ratio of earnings, the ratio of the EBIT to the DA, right? The depreciation and amortization on this is, I think, going to be a significant portion of their EBITDA. I don't think it's being represented. Usually you can tell the difference between net income and EBITDA, but in this case, there's almost none. And in a manufacturing operation like this, there has to be some. And so my guess is that, either you're talking about fully depreciated assets already, in which case you need to factor for CapEx, because these numbers don't reflect, the maintenance CapEx or just even the replacement cost CapEx that you would face. But I think when you actually pencil a realistic scenario, the free cash flow that's going to be available for debt service is substantially lower.
Good point. So I take my 900 down to maybe 6 or 7. That's what you're buying. Yeah.
So this
that's
sounds like a
3
great deal.
multiple.
Who brought this deal? It was me.
Oh, good choice. So we're not buying this one then. Back to
Okay,
what we're
we're
planning to
definitely
do. We're
not
not going to
buying
buy
this
this.
one. Definitely
No.
not buying this one. I mean, there's things to like about this. I mean, there's some tailwinds with what's going on with, more manufacturing coming to the United States, investment by the government, all that. Like, in theory, this is going to be somewhat pretty durable. It's just tough to pay this price. I think that's what it all comes down to. Price matters. I don't know if I told you guys the anecdote, but one time one of my business partners went to a private equity conference, and like this old private equity guy gets up there and he's like 30 years of private equity. And I had one of my associates go through and analyze every single deal we've done over 30 years, try to correlate every single thing to what made a deal successful or not successful. And he goes, we looked at everything: geography, size, industry, trajectory, shrinking, growing, turnaround, scenario, price, everything, month of the year, like interest rates. He said only one thing mattered in the end: did we pay a good price for what we bought? That was pretty cool. That was worth the price of admission. You pay $1,500, you can go to a private equity conference too. Here's stuff like that.
That is good.
Well, that's a very good point. And usually what is so nice about these small deals that I lend on so often is, if you're within a 3 to 4 range, that's a good price and you can probably be okay. And statistics show that folks are okay. But yeah, trying to pay a multiple like this when, what for? I wonder if the seller's thinking here is all the CapEx. I've spent, X amount on all these machines and these machines are worth this. And I hear that a lot. It doesn't matter if they're not producing the cash flow. That's not something you're going to buy that way.
This totally smells like I need to get this number to pay off my loan and buy the boat I want and that Florida house repairs I want to do. This is totally what it smells like. So the formula for sales price. And then, I don't know, if you're a broker, like this is part of why being a broker is so hard, because they're incentivized to take listings like this and price them too high and waste people's time. And with the hope that 3 years from now, they'll come to their senses and sell something at a reasonable price. And it's a tough business, very tough business.
As a lender, I've seen people bring one deal I'm thinking of that I think I saw 4 different buyers bring it to me over 2 years. And in the end, it finally, I don't even think, I didn't even do the loan, but I followed up, and it closed about 2.5 years after it was initially listed, much lower. But it took this, and it got into, got under LOI multiple times during that 2.5 years. Yeah. A lot of people wasted a lot of time.
Is there a strategy here with a listing like this? Let's say you knew that you wanted it. Do you go to the broker and say, hey, I'm interested, but here's the price I'm going to end up paying on it. If something changes, call me. Otherwise, I don't want to waste your time doing a bunch of work. Like, is that a fair strategy, or are you just wasting your time doing that?
I don't think they're going to call you.
Well, I think what you do is you show genuine interest, right? You sign the NDA, you get the SIM, you ask really thoughtful and genuine questions, and you assess the situation. Because you can't really, what good is an IOI that comes from somebody that the broker's never talked to? They're going to be dismissive of that anyways.
Right.
And maybe my tact is always to ask, questions that get me past the broker into the seller. So if I'm asking specific enough questions that demonstrate that I understand the nuance of the business, the broker's going to be like, hang on, I've got to get the seller on the phone. This is going to be way better because they're going to jive with what you're saying. You have the conversation with the seller and you build rapport. You just show that you're genuinely interested in the business, and that you, even if you don't know the industry, you know enough to get to the kind of meat of what's going on. And then you say, hey, look, I'm really interested, but I can only pay a certain price relative to what the market will bear. And you write them an IOI or a proposed term sheet, or hopefully not an LOI because it's a little bit overboard for that stage, and say, hey, look, this is my thoughtful and genuine offer. They say, you're crazy, I would never take that. And you say, no problem at all. I'm not going anywhere. Would love to, pick back up the conversation anytime you're ready. The problem is that, the vast majority of people who are in on this side of the table, right? The buying side of the table is they can't necessarily say, hey, I'm not going anywhere. I'll see you in 2 or 3 years if you change your mind, because they're going to move on. They've got to go close a deal within 2 years or they run out of their runway. And that's where I think these kind of long-term, holding company, long-term focus, kind of patient capital, it's one of their big strengths is they can kind of, play the long game and let it play out and let it kind of mature.
Good point. And the folks I've seen this happen to, they're still searching and the seller will go to a different buyer and sell to that lower price. So I think like psychologically, the sellers there's a dynamic where they're insulted.
Yeah.
And no matter what, even if they've come around to that price, 6 months later, they're not coming back to you because you insulted them. So it's really tough. I say just walk away. If it's priced really unrealistically, go find something else. It's hard to waste your time.
Yeah. We had that precisely what we were talking about, Heather. We had that happen once where we offered 2.5 times EBITDA for a business. And they were like, how dare you? We never sell it for that. It turns out they wouldn't sell it for that. They sold it for 2 times EBITDA to some other guy later on.
So, I've seen it many times. Yeah.
I think the other side of what you're saying though, Heather, is if you're too picky, right, you'll never get anything across the finish line. And so you have to go, kind of quote, waste time. You have to go on a bunch of site visits. You have to have a bunch of phone calls. You have to go through all those motions, because if you just say, oh, I would only, do things up and above this level, that pencil this way, you'll just spin your wheels for years and years and years. And, you're picky to the point of, no activity.
True. And as long as I tell my clients when something doesn't work out, as long as you learn something from it, and hopefully a lot, and they usually do, you're right. To your point, you gotta, that's the learning curve that you're coming up. So as long as you're getting something out of it that way, it's just, don't waste. It's really hard how to know not to waste too much time. Like at what point should we cut bait and move on? Not easy.
Or just go start a business. It's the other thing I tell people, like,
yeah.
Like I've seen people go on searches and I'm like, you know how many businesses I've started in the 18 months you've found nothing? It's like, just to go build something. So anyway, I don't know. I'm not supposed to talk like that on an M&A podcast, so I'm very sorry. But
yeah, right.
We're going to do another episode. We just did one about how we're going to buy a business. Now we're going to do another episode on how we're going to start a business and document the process.
Yeah. Yeah, I don't know. That's people have asked for that kind of stuff. It's really kind of boring. It's like, it's not good radio. And, I think that's part of the problem with people trying to learn business from media is there's one of two things happening. You have a situation like the podcasts, like we don't have a ton of brokers as sponsors. Well, why? Because we talk for real about deals. So brokers aren't really that excited about me talking for real about deals and calling brokers funny names. The other thing about it is just like real business is actually pretty boring. Like the same way, like all of those like restaurant turnaround shows or like, bar rescue, like that's not, or Shark Tank, those are not real business. Like there is no real business going on there. And because real business is actually kind of boring. Reality makes for terrible reality TV. That's the thing I've learned.
Mm-hmm. Yeah, we'd be coming on and we'd be like, hey, look, we have our GM, and you would not believe it. They got $500 worth of sales this week, and they're like, that would be ecstatic, right? If you're starting a business from the ground up from zero, like, oh, wow, we had our first $10,000 month. Like nobody's going to tune into that.
Well, so the other problem is like on Twitter or Facebook or social media, nobody talks about their losses. Why don't people talk about the losses?
Yeah,
it's
right.
Because none of these places have algorithms that help with that. And just like you look at it as just a very basic thing, people are like, why don't you share more losses on Twitter? I was like, okay, go tweet one. Go tweet something bad happened to you and be like, something bad happened to me. My wife has cancer, or like, I broke my leg. People's options are retweet that or click the like button. And nobody's going to click the like button when you break your leg. Like how are you supposed to respond to that? So the algorithms naturally make it very difficult to publish reality and give a anything but a skewed view of anything, because you're supposed to like things to get them to be shown to other people. So it's, anyway, as somebody who writes a lot of Twitter threads, I've thought about this quite a bit.
It has to be anonymously. That's the only way people will really tell the tough stories, I think.
It's part of the genius of Twitter. Like all the guys, which hopefully we have some more gals. That's what I think. Are theys? We need some
There's
more.
getting to be more. We're
Are there
trying.
more? Are there more gals?
Like the
There are more
anonymous
gals.
gals, Heather, like trailer park guy, car dealership guy.
Oh, well, we
know-
don't have a good, okay, you guys have thread boy and everybody guy. We don't really have like what are we going to say, gal? I don't know.
Yeah.
We don't have a catchy thing.
Yeah.
Lady. I
You
don't
could
know.
start an
I always
anonymous
try to
one
think of
that
one.
would be like SBA gal, and everybody would be like, Heather, we know it's you.
I do know some people who are big creators, and as a big creator, you have to like be pretty positive and stick to your lane. And I do know some of them that open up these alternative accounts and just poop on people, just like
Right.
all of the stuff
Get it all out.
all the stuff that's been in there, like calling out people's BS, like health influencers who are on testosterone and drugs, like just like all people who say they own companies, and reality is they got 0.1% of advisor shares, like just like calling the. And so I know some of their and there's some in the real estate space, like like just total calling out people's BS, and it's kind of fun to watch. And then I'm like, I feel dirty interacting with this account, and so I kind of forget about it. But there are people that do it.
All right. Well, this was a good one. Yeah.
On that note,
this was a good one.
That is a great example of a listing that you're like, this could be something. And you're like, you dig in and you're like, oh, this is one of the worst listings we've ever looked at. Like it's up there with like worst 5% of businesses that you just should run away from. So anyway.
Well, and there's the slight chance that you go dig into it and there's something there, but that chance just gets smaller and smaller.
Yeah.
All right. Well, on that high note, thanks so much for sticking around to the end of the episode. And if you enjoyed any of the conversation, please let us know. And we'll be back next week to review another deal. Thanks.